You know, when you think about it, a country's budget is a lot like your own personal budget. You've got money coming in, your paycheck, and money going out for all your expenses. Well, for a government, that income is called public revenue. It's the cash that pays for literally everything, from highways to hospitals. So where does all that money come from? Let's get into it.
I mean, it's a huge question, right? Think about that smooth new highway you just drove on, or the public schools in your neighborhood, even the salaries of firefighters. All of that has to be paid for somehow. But where does the money actually come from? That's what we're here to figure out.
All right, so here's the textbook definition. Public revenue is just the total income a government pulls in from all its different sources. You can kind of think of it as the lifeblood of public services. I mean, without it, a government just can't function. Simple as that.
Okay, so to make sense of all this, here's a quick look at what we're going to cover. First, we'll talk about the two main ways a country pays its bills. Then we're going to dig into taxes, who really pays. After that, we'll get into the big debate. What does a fair tax even look like? And finally, we'll put it all together to see why this stuff matters. All right, let's kick things off with the two main faucets that fill up a government's bank account. And you'll see pretty quickly that while it's not all about taxes, they're for sure the bigger of the two.
So the biggest difference between these two really comes down to one little word: compulsory. Tax revenue is something we all have to pay. It's not optional. Non-tax revenue, on the other hand, that usually comes from stuff you choose to do, like paying a fee for a new passport or buying a ticket for a state-owned train.
Now, that non-tax category has some pretty interesting corners. I mean, you've got the straightforward stuff like road tolls and parking fines, but then you've got this wild one called a sheet. That's when the government gets the property of someone who dies without any will or legal heirs. It's not a huge moneymaker for sure, but it's a super unique part of the whole puzzle.
Okay, so we've got it. Taxes are the biggest piece of the pie. But here's the thing. Not all taxes are the same. Not by a long shot. And that brings us to a really important question. When a tax is collected, who actually ends up feeling the pinch?
So first up, we have direct taxes, and they're pretty much what they sound like. The government taxes you or a company directly, and that tax burden, it can't be passed along to somebody else. The classic example is your income tax. It comes right out of your paycheck and, well, the buck stops with you.
And then you've got indirect taxes. These are a little sneakier. See, the government might tax a business that makes a product, but what does that business do? They usually just add the tax right onto the price tag. So when you go to buy that thing, you're the one who's indirectly paying the tax. Sales tax is the perfect example. The store sends the money to the government, sure, but they got it from you at the register.
And this table here just lays it all out so clearly. Look at that first row, shift of burden. For direct taxes, nope, can't be shifted. For indirect, you bet it can. And then check out nature. Direct taxes are usually progressive. And don't worry, we'll get to what that means in just a second. While indirect taxes are often regressive. The examples say it all. Income tax versus sales tax.
So all of this leads to the huge debate right at the heart of public revenue. What's the fairest way to tax everybody? And spoiler alert, there is no one simple answer. Different countries have totally different philosophies, and that gives us three main systems.
First up is the progressive tax system. You're probably familiar with this one if you pay income tax. The whole idea here is based on your ability to pay. It's pretty simple. The more you earn, the higher the percentage of your income you pay in taxes. The goal is to make sure the burden is smaller on folks with lower incomes.
And this graph shows it perfectly. See how as income goes up along the bottom, the tax rate on the side climbs right along with it. That steady upward sloping line, that's the visual signature of a progressive tax.
Okay, next we have the proportional tax system, which you'll probably hear called a flat tax. The philosophy here is all about simplicity. One rate for everyone. Doesn't matter if you earn $10,000 or $10 million, you pay the exact same percentage. People who like it say it's the simplest and fairest way, but critics argue that it doesn't really consider that different people have a different ability to pay that tax.
And the graph for this one? Yeah, you can't miss it. As income goes up along the bottom, the tax rate on the side just stays completely flat, a perfectly straight horizontal line. That's a flat tax right there.
And finally, we have the regressive tax system. Now, this one can feel a little backwards at first. The effective tax rate actually goes down as a person's income goes up. How does that work? Well, a sales tax on something essential like food is a great example. A billionaire and a minimum wage worker both pay the exact same, say, 50 cents tax on a loaf of bread. But that 50 cents is a way bigger chunk of the minimum wage worker's total income, right? And you can see it right here in the graph. It's basically the mirror image of the progressive one. As income moves to the right, the tax rate slopes downwards. It's a clear picture. With a regressive system, the higher your income, the lower your effective tax rate.
And here they are all on one chart. This really tells the whole story visually, doesn't it? You've got that upward slope for progressive, the straight flat line for proportional, and the downward curve for regressive. Three totally different philosophies, leading to three dramatically different results.
So, we've gone through all these terms and graphs, but why does any of this actually matter? Well, it matters because if you understand how a government gets its money, you start to understand what that country's priorities really are. And, of course, how those priorities affect you.
You see, the most important thing to get here is that taxes are not just about raising money. Not at all. They are an incredibly powerful tool for shaping society. Just like it says here, a government can use a progressive tax system to try and reduce income inequality, or it could use taxes on imported goods, we call those tariffs, to protect its own local businesses.
Okay, let's wrap this up with the big takeaways. First, public revenue comes from two main buckets: taxes you have to pay and other non-tax sources. Second, taxes can be direct, where the buck stops with you, or indirect, where the cost gets passed along. And finally, and this is the big one, the system a country chooses, progressive, proportional, or regressive, is never just a boring technical detail. It's a huge statement about what that society truly values.
At the end of the day, a country's tax code is so much more than just a boring set of rules. It's really a story, just told with numbers. It tells us who pays, how much they pay, and what it's all for. So that leaves us with one last, really important question to think about. What story is your country's tax system telling about its priorities?